The challenge going forward is that once the debt ceiling is resolved, because now that cash drain from the Treasury is pretty much done. They pretty much, they spent the last six plus, maybe 9 months offsetting the Federal Reserve, and now they can't do that anymore. And worse than that, if the debt ceiling is resolved and they're able to issue a lot more debt, their target long term is to get the Treasury cash account back up to half a trillion. So, $500 billion roughly that they want to increase. So they want to suck liquidity back out of the market, while the Federal Reserve is still sucking liquidity out of the market. And so we risk going from a sideways liquidity environment to a deeply negative liquidity environment unless one of these entities blinks and changes course.
The debt ceiling is often compared to the night of the living dead in the financial markets, representing a dormant, an outdated relic of legislation that resurfaces when Congress begins discussing it. It haunts the economy until a group of determined politicians find a way to temporarily resolve the issue, postponing the problem for another day. In a video, Lyn Alden shares her perspective on the debt ceiling, the potential of a nominal default, and the impact on liquidity. Alden explains that if the U.S. federal government is on the verge of a nominal default due to the constraints of the debt ceiling, the president could potentially invoke the 14th Amendment. This would allow the Treasury Secretary to disregard the debt ceiling and issue new treasuries beyond the limits set by Congress. The purpose would be to fulfill authorized spending obligations and manage the national debt. The ultimate outcome of such a decision would likely be resolved by the U.S. Supreme Court when it faces legal challenges. To gain a deeper understanding of Alden's insights, watch the video where she further elaborates on these matters.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
So the issue is that if that were to be hit, you either risk potentially default on the treasuries, not because they can always print the money, but they have these, again, self-imposed kind of restrictions on how they're going to break down control of it, or they have to start missing some key payments like Social Security payments or military salaries, things like that, because most of the federal budget is not, we think of like the federal government, we think of all the different functions they do, but that's actually a tiny part of the pie chart of government expenditure. The vast majority of government expenditure falls into the buckets of Social Security, Medicare, and military and military adjacent things like veterans benefits, Homeland Security, that kind of stuff. So that's where the vast majority of spending is. And so when you have that debt ceiling, you either start defaulting or you start having to cut spending. And we've been in this period since January where they technically ran into the debt ceiling limit, meaning they couldn't issue new debt, but then they still had a number of levers that they could pull in order to not actually run into those more severe consequences. The biggest one that they can do is that the Treasury has a cash balance that they hold at the Fed. The Fed is, like their checking account. They hold their cash balance at the Fed, and so they always have some amount of working capital. Currently, they target to have around $500 billion. So they have this, like, if you were to say lose your job, like lose your income sources, and you can't issue any more debt, what you'd have to do to maintain your expenses, you'd have to start drawing down on your savings. And so essentially, that's what they've been doing since January, and now we're getting to the point where they're almost out of their cash balance, and they've already used some of the other levers that they can pull. And so now they actually start to hit the crunch time for either it's going to be extended or certain payments are going to be missed. Even the holders of those long duration treasuries are still kind of assuming that even if there's a technical default, they will be made whole some days or weeks later as that's reconciled.
Alden also highlighted additional options available to the U.S. Treasury when the debt ceiling is reached. Firstly, they can utilize their primary cash balance held at the Federal Reserve. This balance consists of funds collected from issuing bonds but not yet spent. The Treasury can deplete this cash balance down to zero before facing a true shortage of funds. Additionally, intergovernment borrowing can be employed, involving a reshuffling of financial resources within the government's accounts. Alden delves deeper into the consequences of these actions and sheds further light on the implications for liquidity, as we will explore shortly.
From a macro perspective, beyond whatever, last minute deal or technical default or whatever they do, for me, the question is, once they get it resolved, what is the next steps for liquidity? So to answer your other question, if you go back, ever since early 2022, the Federal Reserve has been doing quantitative tightening, where they're reducing their balance sheet, and then they're also separately raising rates. And so they're trying to tighten monetary conditions. if we look at the quantitative tightening, what that means is that they let some of their existing bonds mature, and then rather than reinvest those as they would, they just don't reinvest those, which means that as the Treasury needs to reissue them, some other buyer has to come in and buy them. And so the Federal Reserve is basically slowly destroying base money, and reducing their holdings of mortgage-backed securities and treasuries, which means those securities have to be absorbed by other participants in the market. It's very similar to if they were to sell them, with some minor technical differences because they don't realize like a loss or anything like that. They just let them mature, and that's been a liquidity drain. And liquidity drains are very correlated with kind of negative asset pricing. It's not great for markets. QE is kind of like inflation for financial assets. Um, and but that's been somewhat offset over the past 6+ months by the Treasury. So, the market did very, very poorly, especially in the first half of 2022, and extending into kind of the autumn of 2022. The market did very poorly. That's when you had just the Federal Reserve is drawing down the liquidity. And while they continue doing that since then, the Treasury started offsetting them starting around autumn of 2022, especially. And so the Treasury, like I mentioned, has this cash balance. And theirs was above target. They had more cash than usual in their Treasury General account. And we could think of that as almost like a void. They previously issued more bonds than they spent. And so they pulled in capital. They pulled in capital from the banking system and elsewhere. And they're storing it in this void that's not really being used for anything. So it actually kind of pulls liquidity out of the market while they grow that cash balance.
Okay.
Now, when they start reducing that cash balance, they're starting to spend it back into the market. They're basically pulling it out of this like liquidity void and putting it back into, circulating liquidity. And so as they draw down their cash balance, it's pro liquidity. And so for ever since autumn of 2022, they've been roughly offsetting the Federal Reserve's quantitative tightening. They've been putting liquidity into the market about as quickly as the Fed's been removing liquidity from the market. And so liquidity was going down for the first, say, 3 quarters of 2022. But ever since then, liquidity's been going sideways. And if you look at the reason that's relevant, and this sounds very jargony, but the reason it's relevant is because the dollar index peaked in autumn of 2022, right
Okay.
when liquidity indicators started going from down to sideways.
Yes.
The S&P 500 bottomed right at the same time. The Treasury market in that autumn period was getting very illiquid. You were starting to have like bad tailing auctions. The move index was like at like record highs. It was a really kind of messy Treasury environment. And that's also when the UK gilt market broke. It just outright broke, and the Bank of England had to come in and do like emergency QE to save the UK pension system and prevent like this like spiral, this like liquidity spiral. And so that like transition to a flat liquidity environment was relevant for a broad swath of assets.
Tuesday's negotiation talks initially raised hopes of reaching a deal, buoyed by optimistic remarks from President Biden and House Speaker Kevin McCarthy the day before. However, McCarthy reportedly dashed those hopes in a closed-door meeting with Republican colleagues, stating that a deal was still far from being reached. This back and forth has left investors on edge as the countdown to the June 1st deadline approaches, which Treasury Secretary Janet Yellen had warned could lead to a default. While we believe the debt ceiling will eventually be lifted or suspended, the journey to that resolution could create significant market instability, as noted by DeBraco Liquo's chief U.S. equity strategist at J.P. Morgan. Expectations point to a temporary or comprehensive deal on the debt ceiling, which may negatively impact federal spending and trigger contentious budget negotiations later this year. In economic news, the S&P Global's flash U.S. composite PMI from May showed an increase to 54.5 from April's 53.4, surpassing economists' estimate of 53.0 and marking a 13-month high. Additionally, new single-family home sales rose by 4.1% in April to an annualized pace of 683,000 units, exceeding expectations. However, amidst ongoing negotiations and discussions, uncertainty looms over the outcome, keeping investors on edge as the June 1st meeting approaches. The potential impact on federal spending and market stability cannot be ignored, and the resolution of the debt ceiling remains uncertain. As the situation unfolds, we invite you to share your thoughts and perspectives on how you believe this scenario will develop. Please feel free to share your comments below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.